Mr. Erik 𝗢𝗲𝗹 coming to us from Mountain Time today, and I'm excited when we get into these types of conversations directly related to tax savings and how that relates to us real estate investors here in the Real Estate Mogul. Mr. Erik 𝗢𝗲𝗹, welcome to the show.
Thanks, Brett. Thanks for having me. I'm glad to be here.
So you're with a company called Cost Segregation Authority. How did that come about? I mean, you don't go to school for cost seg, right? So tell us a little bit about your path to this point, Erik.
That's a great question. I've got a 16-year-old son. I always ask him, what do you want to do? He's like, Dad, when you were my age, did you say that you wanted to be a cost segregation consultant? I'm like, no, I guess not. I guess you're right. He's like, well, I have no clue what I want to do. And kind of the same went for me. So my background, my degree was in accounting, not by choice necessarily, but I wanted to get out of college as quickly as I could. I hated science. I can't write a paper to save my life, but numbers always came somewhat easy. So I'm like, okay, what's the quickest, fastest way, easiest way for me to get out of this college stuff? And it was either finance or accounting. So I went into accounting, never really used my degree. Right out of college, I went into sales, business development. That took me to the East Coast, lived in Virginia for about 12 years, and then moved to Long Island, New York for about 5. Was looking to come back to Salt Lake. My parents were getting older. I had had kids over those course of time in New York and Virginia. Wanted to get them back here with their grandparents and stuff. And so started looking for jobs. I actually came across this job. It required some accounting background as well as some sales experience. And so I did not know what cost segregation was, like most of us. I had to look it up before I did my job interview. And that was 7 years ago. Fast forward to today. I've loved this job. It's gotten me into real estate. I've always been interested in real estate. Being at this company, attending different conferences, speaking at different conferences, both regionally and nationally, it's really I've made some great contacts to be able to invest in real estate myself.
Tell us a little bit about your real estate investing journey.
Sure. So when I was in Virginia, we had 2 kids at the time. We decided to move to New York. My wife was born and raised in Long Island, New York. And so we moved to New York and we had our primary house. And we said, well, let's turn this into a rental. We're going to move to New York. It was my first rental property. I thought I knew everything. I'm like, I'm not getting a property management group. I can screen these people. And long story short, it was an absolute disaster. So we moved to New York and got some renters in there. I screened them. I thought they were great people. Turns out they were not willing to pay their rent. Then I couldn't.
They worked you over.
Learned a big lesson there that I can't be good at everything, right? Like I know what I'm good at, and property management and screening people is not something I'm good at. And so as I continue to build my portfolio, I've got some short-term rentals now. I'm also invested in some micro apartments here locally. And so as part of an opportunity zone fund, I've invested some of my retirement accounts into those opportunity zone micro apartments. And so that's kind of where I'm at now.
And just wanted to share your personal experience with retirement funds and investing in real estate. What does that look like for you?
Yeah, so I had for my previous job, I had been there almost 15 years at my previous job, had a decent size 401k. And it was just sitting in that 401k. And I felt like with some of the returns I've seen, I got into these opportunity zone, these micro apartments with the founder of our company here at Cost Seg Authority. And I saw some of the returns. I said, hey, those are way better returns than what I'm getting on my 401k. Is there an opportunity for me to invest? And he said, yes. And so what I did was I put those into an IRA. I took those out of my 401k, put them into an IRA, invested those through my IRA into those micro apartments. Now, the drawback of doing that, obviously, when we sell that asset, that money has to go back into my IRA, and I can't access that money till I think it's 65, 64, whatever the retirement age is for an IRA. So otherwise, there's penalties. So it's no different than any other retirement account, whether you were investing in stocks. If you invest in stocks through your 401k, the return on those stocks goes back into that 401k, and you can't access that money until you're a certain age. It's the same thing with an IRA. And so that's where I was able to pull it out, put it in an IRA, And as long as I was investing and putting that money back into that account, I don't have to pay any penalties or tax or anything like that. So that's how I was able to do it. Maybe you guys have heard about that. It's pretty popular now, but it's a great way, short-term or kind of your Airbnb vacation home type properties. If you invest in those as a W-2 earner, those get treated a little bit differently than a long-term rental. So think about an Airbnb. An Airbnb is more like a hotel. And so the IRS says, hey, if the average stay at your Airbnb is 7 days or less, and you materially participate in the management of that property, and there's 7 different tests, you only have to qualify for 1 to show material participation. If you can materially participate in the management of those properties, then we're going to allow you to use those deductions. Basically, you're saying, hey, I'm a doctor, but on the side, I run this hotel business. And so because you're running a business, they allow you to use those deductions from your Airbnb to offset not only your Airbnb income, but also your active W-2 income. So a lot of high W-2 earners will invest in short-term rentals, use those deductions to offset their doctor income and pay less tax. And so that's a great way to, listen, you're gonna pay that money anyways. I'll give you a real life example here, Brett, because I'm a W-2 employee and my wife is in the school district. So at the end of 2022, I had made decent money in 2022, and I was going to owe about $80,000 in taxes come April of 2023. And so at the end of 22, I bought a short-term rental at a nearby lake here near Salt Lake. And I was able to do a cost-sake study on that property. I was able to get back about $60,000 out of my $80,000 down payment in terms of tax savings. Had I not done that, I would have just paid that $80,000 to the government and never seen the money again. Instead, I basically used that $80,000 as a down payment on my property, got $60,000 of that back, and was able to now have a revenue generating short-term rental at a nearby lake here to Salt Lake. And so being strategic about the type of assets that you're investing in is helpful. So when you buy a building and you sell it, you pay 2 types of tax. You pay capital gains tax, and you pay depreciation recapture tax on the depreciation you've taken on that asset. So I'm sitting here telling you to front load and take all as much depreciation as you can, and CPAs are like, well, that just means I have a bigger tax bill at the end. And the answer is no, and I'll tell you why. Let's say I buy a building for $1 million. I sell it 5 years later for $2 million. Okay, so it doubled in value over 5 years. When I go to settle up with the IRS, I'm telling them that everything's doubled in value. My land is doubled in value, my walls have doubled in value, my roof is doubled in value, and guess what, IRS? So is my dirty, nasty carpet that's 5 years old and stained. Why are we selling our dirty, nasty carpet for more or double what we bought it for? The IRS says carpet is a 5-year asset. So what is my carpet's book value after owning it for 5 years? 0. It's fully depreciated. I've owned my 5-year asset for 5 years, which means it's fully depreciated and it's worth 0. But when you don't do a cost sake study and you have everything grouped together, I bought all this stuff for $1 million. I'm now selling all this stuff for $2 million, and the IRS is charging you tax on that. What should happen is when you sell your asset for $2 million, you should allocate the sales price to the land, allocate the sales price to the building, but don't allocate the sales price to the carpet, because the carpet is not worth more today than what I bought it for. And by doing so, you're creating what we call a rate arbitrage, where you're taking your deduction, your depreciation deductions against your ordinary income, paying it back at a capital gains rate, and saving the spread. And sometimes that spread could be as high as 17%. So take the deductions against your ordinary income at a high rate, pay back a portion of it at a lower rate at a future date, and save the spread. And that's really how cost segregation benefits you when you're selling an asset.